Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Stock sell-off. Wall Street has its worst day since the August meltdown as growth worries fuel a flight from risk. US and European futures point lower. Nvidia's record rout. Worries over AI wiped $279 billion from the chip maker's value, the biggest one-day loss in American stock market history. Antitrust concerns also linger. Plus, oil extending declines this morning after a 5% drop yesterday. Focus now shifts back to OPEC's plans to boost output, even as demand concerns persist.
And as we really digest all the red on the screen overnight, it continues into today's session. You are seeing futures in the Eurostock 50 really take that lead and that tone from Asia and from the United States, down about 1.3%. Slight, I wouldn't call it outperformance, but not as much of a hit on the FTSE 100, down about 0.8%. We'll see how that shakes out at the open, just given that indexing towards the Brent Crude story. And, of course, Brent Crude down about 0.4%, a 73 handle there. The one spot of green on the screen is in euro-dollar, 110.54 on that currency pair. The countdown to the opening trade starts right now.
Wednesday, the 4th of September. Welcome to the opening trade. We're back to school with a bang. September starting as August did in so many ways, with a significant sell-off. The question now is, are we going to see a similar bounce back to the one we saw back then? Here, now, do you buy this dip? That's the question a lot of people sitting down at their desks this morning are going to be asking themselves. Indications are the European futures are going to follow through with some downside. We've just seen Japan's Nikkei index falling 4.2% at the close, Anna. Do we bounce back? Is this a buy-the-dip moment? What are we going to see?
The futures don't suggest we bounce back in the near term, do they? I mean,
nope.
Kriti just talking about the futures picture. Yes, it looks a little brighter in London, but it looks negative. Yesterday, we did capture some of this negativity in European session. We were down heavily on basic resource and energy stocks, but we possibly have some work to do, and that's what the futures reflect. Yesterday, on the S&P and the Nasdaq, it was a bad start to September, a seemingly slightly almost historic bad start to September for US markets. And part of that was concern about the broader picture, the US data, the Chinese growth story, but there was also the overvaluation of tech stocks in there. A couple of notes that maybe usually wouldn't have touched the sides around AI and concerns about that really seem to hit the mark because this seems to be a market that is priced for some kind of AI perfection.
Yeah, there's a lot of different reasons of why that could happen, and you mentioned seasonality as being one of them. It's usually a drop of about 4% in September. There's talk about potentially that chip pain being some sort of Trump trade in the works as well. There's an options unwind as a part of that, not to mention some of the data we got yesterday as well.
Stocks go down. Shocker.
And Nvidia went down a lot by a record amount.
Yeah.
Record amount.
Meta, I suspect, is very happy to hand that crown over.
Yes, it's not a crown you want to wear.
That's the value of Chevron that it lost yesterday.
Right, $279 billion.
Yep. That takes us to oil.
I don't have the time to argue about why stocks don't always go down, but we'll talk about oil because oil absolutely does as a macroeconomic judge. But this one also feels really interesting because we've seen so many geopolitics kind of in the world that have been potentially moving the oil price, and we've been wondering about the complacency of it. This time around, an almost 5% drop in oil, erasing all of the gains this week. Jeff Curry over in the States actually making the point that this isn't just a China story. This is broader. Yeah,
absolutely. He was talking about China, but also talking about the US data, but saying none of that actually seems to be bad enough to add up to the market being as short as it is right now. So he's quite surprised as to how negatively this has all been taken. And Libya, we don't talk about this story much. We'll get an update from a reporter later in the programme. But what's going on politically there could open up the way for more oil flows out of that country.
What is oil telling other assets? At the moment, we don't seem to have much kind of cross-pollination when it comes to the cross-asset story, and there doesn't seem to be that. These stories feel different in some ways, but in some ways, oil is telling a story of a global economic slowdown that stocks maybe haven't fully accounted for. The bond market, which saw a big move yesterday as well, maybe has. And you just kind of wonder, as we go towards the JOLTS data today, as we go towards the employment story later on Friday in the United States, what is the real macro story? And is oil maybe telling us something that we need to pay attention to?
And we certainly saw commodities negative on that front. I mean, if bond markets aren't responding to this, bond markets are also responding to the politics. And I know that's something that you've been watching really closely.
Absolutely. Let's talk about French politics. Yesterday was a funny day. So the readout, the French papers are full of them this morning, the readout in terms of how the day went yesterday. So Cazeneuve apparently was out by lunchtime. Apparently he didn't agree with Macron in terms of the policy and wanted to kind of present himself as an independent. So he's kind of toast. Xavier Bertrand apparently would struggle to pass a vote of no confidence. The RN made that clear. The Socialists made that pretty clear as well. You had Thierry Baudet. He would have been eaten by the political wolves. So he's a technocrat, but the politics around it are so vicious at the moment that actually he wouldn't have survived that. So the RN did say that it would back a technical candidate. So I don't know whether we're much further forward.
No, I'm really fascinated by how we're working down the clock here towards the budget. And that struck me as interesting from our reporting out of Paris overnight, suggesting that the less time there is to debate the budget, the more the budget might look like what Macron had intended, first off. I wonder where that thought takes us.
I was about to say, is that by design, perhaps? And just for everyone's radar here, September 20th is the budget decision that they present to the EU. And even then, they present it, there's some kind of cushions that the EU can still provide on those budget negotiations.
So yesterday, the outgoing government had to send details of its projections for the budget to the parliamentary officials, and they flagged the risk the deficit could be 5.6% of GDP rather than the originally projected 5.1.
Yeah.
So the numbers could look, yes, maybe this is working in Macron's favour, but the numbers could look really bad.
They could still scare.
So, and you wonder how the market would react to a big overshoot in terms of those debt to GDP numbers. What have we got on the programme to help you understand all of this? Who have we got? I guess it's probably the question that I should really be asking. Peter Herwick, CEO of the French technology company Schneider Electric, is going to be joining us at 7:30. We're going to talk to him about Nvidia. We're going to talk to him about the green revolution that should be happening in Europe, what's happening with the new commission. So many subjects to discuss with him. Oaktree's Madeleine Jones is going to make the case for judicious credit selection in the second half of the year. The supply at the moment is epic. We'll talk to her about just how careful you need to be, because at the moment it feels like a frenzy out there. Market Open, IG North America's JJ Kinahan is going to be joining us. Yesterday was quite the ride. What did he make of it? Where is he going to take us? What does September look like? We're going to take on what US equities are going to deliver this month from him. So plenty to discuss on the programme. And this week is really getting going in terms of the events that we need to be watching. JOLTS really stands out for me today. Yeah,
it's a string of data that we're going to get, durable goods, factory orders as well. Coming off, by the way, right off the weakness that we saw in the ISM as well. And that's coming alongside plenty of things right here in Europe that we have to keep an eye on. At 12 UK time, ECB Governing Council member Francois Villeroy de Gallo will be speaking. I already mentioned the data. We'll dive into that throughout the show. But to me, the highlight actually happens at about late afternoon, if we can. Indulge me. We do have Spain announcing their new central bank governor at 2 p.m. UK time, 3 p.m. over in Madrid. It looks like Carlos Cuerpo, the economy minister, is looking to make that announcement. The expectation is this is for someone who's going to maybe return and get that vote in the ECB. This is a big deal from a voting standpoint because Spain hasn't had that voice in the last couple of meetings. That alongside, just an hour later, Mario Draghi speaking to Parliament. It's a closed-door meeting about that competitiveness report. We don't know what details we're going to get, but these are two major stories that can move both fiscal and monetary policy.
The Draghi report's going to be much delayed. Like it was meant to come before the EU votes earlier this year. The story is that von der Leyen delayed it because she's so worried about what some of the findings of Draghi's report are going to be.
Well, I think, yes, it does seem to come down to, in some of the wider reading about this, it does seem to come down to, is there a conflict in Draghi's mind between the green agenda and the competitiveness agenda? And if there is, how is he going to square that? And that it nicely fits in with some of the conversations we're having with guests today, actually, around Schneider, for example. But yeah, I mean, how do you do whatever it takes on competitiveness? I have mixed feelings about this story, because on the one hand, Draghi is a serious character. You have to take it very seriously. Yep. On the other hand, we've talked about competitiveness and a lack of it in Europe for decades. Yeah,
we need a big crisis for Europe, maybe to sort its competitiveness out. In some ways, we should have one right now. Is it going to be enough?
Well, that's the part of his argument that got leaked, right? That because we need to have that ramp up in terms of defense, competitiveness is getting in the way. We'll see what other pieces actually come out of that.
OK, let's get an update on some of the other stories that need to be on your radar this morning. The Ukrainian President Volodymyr Zelensky has restated a call for air defense systems after Russian missiles killed more than 50 people in one of the deadliest strikes since the Kremlin's invasion began more than 2.5 years ago. This as a broader government reshuffle takes place in Ukraine. The country's foreign minister, the latest to submit a resignation following 3 cabinet resignations yesterday. Elon Musk's satellite internet provider Starlink has reversed course and says it will comply with an order by Brazil's top court to block access to X. It comes amid Elon Musk's bitter standoff with the country after a Brazil Supreme Court justice ordered the social media service be banned as part of a campaign against disinformation. And the German government plans to cut its stake in Commerzbank as it seizes on a recent share price rally. The government owns just under 17% of the bank, with the stake worth around €2.5 billion. The country's finance agency has now disclosed how much it would sell. Has not disclosed, sorry, how much it would sell and when. I mean, typically that's the way these things go. Governments have stakes. If they want to sell them, they don't telegraph it too much. But I guess you would assume, given what we've seen lots of other governments around the world, this is still a legacy of the financial crisis. You would have assumed this was coming down.
Yeah, they're not going to sell all of it, seems to be the message. We're going to sell some of it, not going to sell all of it. I remember when this went into public hands during the financial crisis and just how bad shape Commerzbank was in at that point. It's taken a long time. You think about the legacy of 2008, how long it has lasted. Here is an example. I think it takes us back to the frothiness of the market today. We don't know where the next crisis will come from, but it's fascinating that we're still dealing with the legacy of the last one. I
think it's also fascinating that this is, I mean, this week, and I would say the last week as well, has just been filled with news out of Germany and how they're recalibrating, not only post their elections, but in the corporate space as well. Volkswagen, of course, was the headline, it felt like, of yesterday. And now that we're seeing this kind of refinancing around Commerzbank as well. Yeah, absolutely. And as you were saying before the show, Kriti, you know, that even if this is opportunistic and takes advantage of the interest rate positioning that we've seen running up to this, not the interest rate position to come from the ECB from here, it does at least help in the short term to fix a bit of a budget hole, doesn't it, depending on how much they sell. We will look for details there. Coming up on the programme then, Spain is set to announce a new central bank governor, as Kriti was just telling us. Jose Luis Escriva reportedly set for the top job. We will discuss the potential appointment. He is certainly the person being mentioned by Spanish newspapers. We will see where that takes us. But up next, we'll be joined at the desk for an exclusive interview with Peter Herweck, the CEO of Schneider Electric. Plenty discussed, including AI and data centre demand. That fits in nicely to the market turmoil we saw stateside yesterday. If you have any questions for our guests, please send them to us. We do like to hear from you. IB plus BBTV Go is the function. This is Bloomberg.
There are countries, markets like the UK and the Netherlands, where clearly the grid is maxed out, and any connection of large consumers takes 7 to 8 to 9 years. So if you don't have a grid connection, you are in a bad place.
CEO of the German energy giant E.ON talking to us back at the beginning of August, midway through August, talking about the restrictions that the grid is placing on the AI data centre story and how big an effect that could have and how long those restrictions are likely to last for. Just one of the problems that the AI story is facing right now. There was a pretty big one yesterday, like a massive sell-off in Nvidia. And as you were saying earlier, the biggest sell-off we've ever seen by a single stock. Questions are being asked about the AI story, about the returns, about whether or not those returns are going to crystallise soon, and whether or not actually these big companies, the hyperscalers that have spent so much money, are going to see an ROI at any time soon. Yes, and we are at a point where people are questioning whether, you know, surely there's a big opportunity in AI and there's going to be more data centres in the future than there are now, but how big is that opportunity and what is it really worth? And this doesn't just matter to some of the tech names we talk about all the time, the likes of Nvidia, who supply the chips, but all of those other companies, Kriti, that provide parts of that data centre infrastructure. And that takes us on to our next conversation. Yeah, infrastructure, but then also the other sectors that aren't quite hit by the AI story. And this is the argument that Nvidia is making, that this is something that could end into renewables, into infrastructure, as we talked about, but also things like medical equipment or things that could go so much further that maybe we can't even envision right now. We're going to watch that story very carefully as this session unfolds. But let's get an interesting angle on what is happening here. Peter Herweck, the CEO of Schneider Electric, joins us now around the table. Nice to see you this morning.
Thank you very much for having us.
How closely are your fortunes, Schneider's fortunes, tied to Nvidia?
you know, we said in 2023, 21% of our business was related to data center networks. So 2/3 in data center, 1/3 in networks. And with that, the data center build-out is important for us. Now, if we look back the last 5-10 years, it's always been a double-digit grower for us. And if you're looking today, a majority of the build-out that we have in data centers today is still related to cloud.
Right.
Now, AI is coming on, so from that perspective, it will continue and it will come. I've always said there is no exponential growth in what we do because we're guys that put the cables together, that build the switchgear, that need to make things happen. Some of those data centers take 18 to 24 to 36 months to build. And when you look at the chips, some of the announcements are about chips that come to market in 2028. Until they are deployed in data centers, we're talking probably a year on top of that. So I don't see any harm to the business in the next 5+ years.
So you've got pretty good visibility on what is going to be happening.
Absolutely.
We're just hearing from the CEO of E.ON talking about the restrictions, though, in terms of plugging those data centres in. To what extent is the industry being throttled back by the lack of investments in the grid, the lack of capacity that exists out there?
So to put it into perspective, today data centers in the world roughly need 1.3 to 2% of the world electricity, and we're anticipating that to grow and double until 2030. Now, if you were to compare this to the electricity usage of electric cars, it's probably at the moment at 0.5%, and we anticipate this also to go up to 4%. So there is quite some dynamic there as well. And I think that's all okay because electricity is the most efficient secondary form of energy, and if generated renewably, it is CO2-free. So in the energy transition worldwide, anyway, we need more grid built out, and what Leo said is quite the fact, and that's why the European Green Deal focuses on grids. That's why the IRA focuses on grids and renewable build-out. But as I said, there are physical limits to it. You know, it needs electricians, it needs factories, it needs work. It's not going to be exponentially scalable.
I wanted to ask you about that E word, exponential. So you say there is no exponential growth because what you do relies on physically people getting to places and delivering things. But, I mean, how much growth could there be then? You say you've got some visibility. You sound to be at the foothills of AI if actually what you're benefiting from now is still cloud technology.
So, and AI is coming on, no question. You know, we've said just recently at our Capital Markets Day that the segment of data center and networks is growing for the next 5 years from a market perspective, double-digit. And, you know, I know that there are people out that say, you know, 30, 50% and so forth. I hear all of that. But we have the experience over several years, and the top 10 builders of data centers are our clients today. And 4 out of 6 actually also buy services from us in respect to sustainability, which is on their agenda. So I think there's going to be solid growth to be expected, but we've always said it's not exponential.
Okay. And you mentioned also the green policies of Europe, and they clearly play to your favour, I assume, and the IRA over in the United States. This is a sweet spot for a business like yours. We're waiting to hear from Mario Draghi this week, further details of what he thinks about European competitiveness. Do you see a conflict between the green policies of Europe and competitiveness, or are they entirely symbiotic?
I think it's essential for, if I go to the CEOs of our clients and I said, what's on your agenda? And usually it's 3 things that we're hearing. Number one is they are in the digital transformation. Secondly, they worry about the resiliency, the availability and the cost of energy and how they can do it in a more efficient way. And then many of our clients, most of our clients have actually given CO2 commitments and sustainability commitments where we can help them. And that's at the heart of what Schneider does.
Anna was talking there about the politics and the kind of budgetary fiscal constraints. And you mentioned as well from the IRA, from the EU, in 6 months you may not have that same guarantee or that same support on both sides of the Atlantic. And I'm curious how you're positioning for that for a company like yourself, which is very exposed to the grants that you're getting currently from the Biden administration.
The way I would see it, and it's independent of the geography where we're active, the company is set up for the long run. Electrification is going to come in the long run. Today's energy mix, 20% in 2020 was electric, and we expect in 2050 it to be 50%. So there is going to be a huge build out in electricity. All the scenarios that have been built also by the IEA show in this direction. Now, if it's 5% more or less, who cares in the long run? This is a quite underlying positive trend. And the second thing I've experienced in many years is if budgets go up. If administration changes, I've rarely seen those budgets to go down. They may get different names. And from that perspective, some of those build-outs are just continuing on, and they're necessary for competitiveness in the Americas and also in Europe.
But what does that do then? Okay, let's dive into the long-term side. Anna was talking a little bit about that transition between cloud and AI. Cloud has been around for, I would say, 20, 40 years now, and you are still seeing that build-out actually be adopted in a lot of companies like yourself. The transition to AI has been cited as one that's more expensive, that requires a lot more CapEx, at a time when so many corporates are just now getting on the cloud bandwagon, for lack of a better term. What is the marginal difference to you from switching or even improving or upgrading from cloud to AI?
So today you would say that probably an AI data center requires 4 times the energy of a cloud data center. But if we also look back and take some of the learnings of the history when the first CPUs came into the market, central processing units, over time they became more energy efficient and they could process more data. So the cloud deployment, while, as you rightfully say, has been around for a long time, it really started in the second half of the second decade. So from 2015 onward, we saw cloud really grow.
But that was a cost thing at the end of the day.
Well, at the end of the day, the cost went down. But if you look at the efficiency that some of the GPUs, or the graphic processing units that are used to train and use AI models, if you look at the efficiency of the new processors that come out, there are also massive steps forward. So the anticipation is that the power usage for the same processing will also go down, and we've seen it with the announcement that have come out. Now, that's a normal productivity that I think we need to see.
Changing gear completely, you're a big French company. We're all talking about what's happening with French politics right now. As the CEO of a big French company, are you concerned about what is happening in Paris right now? Do you think it has a material impact on the way that your business will proceed from here? Taxation, budgets, there's a lot of economic impact that could come from this. So
you'd be surprised how un-French we are.
Okay.
While of course we have a strong heritage in France, we're listed in the CAC 40. We're registered in Rueil-Malmaison, close to Paris, and of course there is history in the company. But then there is roughly only 5% of our business that we do in France. With it, we're a very globally
How much your workforce is in France?
We have probably 20,000 people in France out of 165,000. Okay. So there, of course, I'm concerned as a business leader in any jurisdiction where we operate, in France in particular, if there's instability. Business people want to have a predictable environment, and so this is not nice. It's not nice in other countries in Europe, and it wasn't nice in Europe. And we've had a couple of months of India of uncertainty how things will go. So from that perspective, those are elements we do worry about.
I've got 30 seconds left. An audience member asks about why you're doing convertibles right now. Just tell me in 10 seconds why you decided to go right down that hybrid route.
It's just a way of being prudent in respect to financing.
Nice to see you. Thanks for stopping by. We really appreciate it. Peter Hoek, CEO of Schneider Electric. Coming up, we're going to be talking about that credit markets. There's a record rush. There's a frenzy in the credit market right now. We're going to talk about it next. This is Bloomberg.
30 minutes from the start of the opening trade here in Europe. Let's have a quick check of where we are on the futures picture at 7:30 a.m. UK time. Futures are trending lower. We are expecting to see further losses on European stocks today. We saw some of those losses in that AI story in the States captured in European trading yesterday, very much centred around energy and around basic resources, so slightly linked to the China growth story as well, of course. So we saw some of that, but we need to play catch up a little bit with the extent of the losses in the United States. The S&P down by more than 2% in session yesterday. Checking on bond markets, and yesterday we saw yields coming down stateside, a real focus on growth, whether it's Chinese or the US services data, what that told us around manufacturing, what that told us around the growth story. So we're focused on that yesterday, and that filters into the European session. We see some yields coming down a little. I can see every country on my in Europe on my WB bond screen. It's showing me that yields are edging down just a touch this morning. Let's think about bond markets then, Kriti, and I know you have a chart that's caught your eye.
It has. And look, I think we talk a lot about it on the macro sphere, what the bond market is doing, what kind of monetary policy it's pricing in. We should talk about how that translates to the actual credit markets, which brings me to this chart. We're looking at the high yield story over in Europe, specifically adjusted for inflation. Now, this is a big deal. I'm going to walk us through the history a little bit. So ignore this side of the chart for a second. But we're going all the way back to the pandemic, where you did actually see European high yield offer a pretty juicy return. That really came down to a point where it was negative, where that actually adjusted for inflation was not a benefit to your portfolio. We have since come back, but not to the levels that we've seen in the past. In fact, it's actually stagnated. And this, by the way, Guy, and I think you mentioned this, comes in line with a lot of issuers on both sides of the Atlantic suddenly trying to access these markets, trying to issue ahead of a lot of geopolitics and a lot of potential rate changes.
Feels like there's a lot of pull forward right now, doesn't there, Kriti? Everybody's trying to get out in advance of some of those key political events that we're watching at the moment, and you wonder what the latter part of this year is going to look like from an issuance point of view. Madeline Jones, who manages European high-yield bonds and European senior loan strategies at Oaktree Capital Management, joins us around the table. Good morning.
Good morning.
A frenzy. I keep hearing that word. There's a lot of issuance. Everybody's trying to get out in advance of some of the big events that are coming towards us. When I hear frenzy, I don't hear a market that feels very selective. But is this a world in which you do need to be selective to prepare for what is coming towards you?
Oh, yes, I think so. I think, well, we have a good front row seat on what's going on in companies. We look at hundreds of companies in Europe in some investment-grade debt territory. Last quarter's numbers were very good, but around the edges on the outlook in particular, you were starting to see some moderation from the beginning of the year. And I'm particularly thinking about chemicals companies here who were reliant on China, reliant on the construction industry to come back. And we've sort of seen those going from expecting a trough and an uptick in demand in the second half of the year to now seeing the trough, which is good, but not seeing the uptick. So you're seeing around the edges a moderation on the outlook, and we've been pricing that in. We've been thinking about that, how we might want to adjust and be more selective. You've seen different parts of Europe having very different growth trajectories. Germany, Northern Europe looking quite challenged, Southern Europe looking better. We've talked at Oaktree a lot about, and we've released a report about the dual economy with different classes of consumer, lower middle income consumer, now being challenged by the rates and inflation that are coming through in more moderate consumer decisions and adjusting consumer behaviour, but the higher income part of the economy doing much better. So there's different fractures in the economy, and we have to adjust and be more selective in light of that.
Given all of that, and given there is clearly some dispersion now in terms of how people are perceiving some of these credits, rates are going to be coming down. Is the rate reduction that we're going to get at a headline level enough to keep even the more stressed credits kind of on the road at this point in time?
Well, some of those credits, and probably we're talking about the loan market more than the bond market, and I appreciate that slide just before on the yields. You know, the bond market now is predominantly double B market, so the quality really is why that spread does seem appropriate, that spread reduction. In the loan market, you do have some structures there which were put on back in 2019, 2018, whose maturities coming due. They were structured around a very low interest rate environment. Yes, we will see a moderation in interest rates, which will help them for sure. But for some of those loan issuers, it won't get to the levels where they start to look like they can refinance easily. Those maturities will start to bite. We'll probably see it 25 and 26. We're expecting peak defaults. But This is a small minority of the loan market. Most of those companies have been able to grow into their balance sheets, have been able to refinance, extend out maturities. So you're talking around the edges, 4 or 5%, leaves a lot of the market, which is highly investable still.
OK, Madeleine, that's interesting. Just to linger on what you're acknowledging, you say it's a small part of the market, but it's interesting that we're going to get peak defaults at a time when rates are going down and will have been going down for a period. Is that always the case? Is that just sometimes these rate cuts, they just come too late?
Yes, I think so, but you're also reflecting against the rates they were put on at, which were 0 and negative, and that's when they structured their balance sheets, not with a view that rates were going to be where they are today. So, that context is vastly different when they were making their balance sheet decisions all those years ago.
On the wider corporate space, away from those more distressed names, and going back to what Guy was talking about the amount of supply we've seen coming in, and typically this is seasonally often a busy period, start of September, and that sort of back-to-school feel. Yeah. But then there is also the politics that people perhaps want to avoid. So how quiet could things get in issuance terms in the months ahead?
Yeah, no, I think it's going to be really busy. And I'm expecting that pull forward. If you're an issuer who's thinking they need to refinance in the next 1 or 2 years, you're seeing the cost of debt has come down quite significantly. And so that looks like a very good time to access the market. The market, of course, the equities market has been quite turbulent, but credit market, it still has a lot of pent-up demand. The supply of high-yield bonds in Europe has been quite modest. So there's a lot of cash that is around to access the market. I think we're looking for opportunities to invest and rotate our portfolios. If we see a little bit of spread widening because of this pressure on the supply, even better. And I think that's a time we'll be very, very active. So I think there's absolutely demand out there. And again, it comes back to selectivity. There will be companies with good quality balance sheets who will find it fine. They may have to pay a little bit more on the spread, but they'll get priced. There'll be the more marginal credits who are really leaving it a bit late to refinance and, they may not be able to tolerate that little bit of spread widening. They will find it much more challenging. But that's been the case throughout this year. There's been pockets of activity and pockets where the market really has to, take a step back and won't price that marginal company.
What does the maturity wall look like then? Because it kind of feels like there isn't one at the moment when you speak about refinancing.
Yeah, it's been pushed out quite successfully. The capital markets have been open for the last 1.5 years, 2 years. So for any good company who's come to the market, they've found a way, if they have a healthy balance sheet, to refinance and extend that maturity out. So particularly the loan market's been very active in that. Yeah. That's why you haven't seen a big need to refinance in these latter parts. And it really comes due really in 2026. We viewed that as the peak maturity year for legacy loans. The high-yield bond market has been a little bit slower, but we're talking maybe 10% that needs to refinance. And again, we're talking high-quality market, double B space. Companies have been waiting for a good point to access the market and refinance their debt. And, if they're good quality, they shouldn't be troubled by a slight bit of spread widening that we see.
You made a key point, which is that capital markets have been open for the last year and a half that you mentioned. You've talked to the folks in the private equity space. They would say, actually, it's not the pace or it's not the adoption or the acceleration that we would really want. To me, I think what's striking, though, is that the capital markets are actually loosening up more in Europe than they seem to be in the States, despite the economic resilience in the States kind of being what feels like is driving some of the macro story. And I'm curious why maybe Europe seems to be a little bit ahead of the game, not just on capital markets, but even in something like the leveraged loan market, for example. And I can appreciate you specifying high yield credit, but those all have factors. Your thoughts on that regional divergence?
Well, I think the loan market in the US has also been very active. I think there have been some challenges in the loan market in the US on some restructurings, which maybe have clouded the news. But that capital market has been alive. I think mainly the reason why it's been active in both the US and Europe, CLO market has recovered very successfully. Yeah. And with that being the major buyer of loans, we've seen activity on both sides of the pond being very good. And that's enabled those companies to refinance. And that's why we see a very, very limited amount of stress in the market, because successful companies have pushed out their maturities.
Yeah, the structured finance piece is also a fascinating one in terms of structuring the buyouts that some of the private equity firms are facing as well. A final question to you on that regional divergence. When we're talking a lot about the carry trade, we had a guest from JP Morgan talking about issuance last week, joining the program as well. And he was basically saying that there's now more American companies that are looking to issue in Europe to take advantage of the interest rate differential. Are you seeing that in your part of the market?
We've seen that, more in a global context. So I think global diversified companies will see a useful place to issue in European debt to offset any currency need they have in their operational side. We have yet to see a lot of, raising of European debt outside of that. So I think it does make sense, but I haven't seen a step change at the moment.
All right, Madeline Jones, we will leave the conversation there. Of course, managing the European high-yield bond and European senior loan strategies over at Oak Tree Capital Management. A really fascinating conversation, Guy, around some of the credits that we're seeing.
Let's turn back to the airline sector. We talked about this yesterday and what's happening in Cathay Pacific. An update coming through from the airline within the last couple of minutes. Cathay saying that it doesn't expect to make any further flight cancellations, any further cuts, does not anticipate any further flight cancellations. We understand that 6 Cathay 350s, this is the Airbus jet with Rolls-Royce engines upon it, have been repaired and are ready to fly. A further 9 will be ready by Saturday. We understand that it was simply just a fuel line within the engine that has needed to be replaced. There was some concern that it was going to be the manifold, which is a much kind of bigger piece of kit which distributes fuel and air kind of one way or the other, depending on your point of view, around the engine. So it looks like a relatively straightforward fix. Now, these are thousands. These are 350 1000s. Other operators of the 350-900s have been checking as well. We have seen some issues with some of the other Asian carriers, but at the moment it looks like Cathay is going to be putting this fairly quickly in the rear-view mirror and will be coming back. So we've seen a bunch of flight cancellations. They're basically operating from Saturday, a reasonably reorganised schedule that is basically back to normal. What are we going to talk about next? We're going to take you back to the tech story. We're going to be focusing on the stocks to watch, including European chip makers. Nvidia suffering that record rout yesterday. AI worries certainly sinking the stock and the tech sector. We're going to talk about the impact here in Europe next. This is Bloomberg.
We're about 15 minutes away from the opening trades across Europe. Sentiment is bleeding into the session already. It looks like when you look at the futures picture, down about 1.3%. When you look at Eurostoxx 50 futures, the 0.9% drop on the FTSE 100. So again, not as much bleeding in the UK index, but you are still seeing it down with sentiment. But again, it is across the board. Some of this really feeding over from the Asian session as well, and we're likely to see it concentrated in some of the tech stocks, just given what we saw in other parts of the world. Perhaps where you're not seeing that same kind of sentiment is in other parts of the market. Let's dive into those details. Bloomberg's managing editor for FX and Rates, Rachel Evans, joins the program this morning. Rachel, red on the screen for the equity market. Why is the bond market not freaking out too?
Yeah, well, I mean, obviously, concentration risks are evident here. You know, with Nvidia being such a big part of the S&P 500, we've talked about that in the past, just how much of a driver it is for US stocks. But for this to spill over into the wider market, you know, we really need to see that risk-off sentiment sort of going into the wider economy, going into kind of people's general sense of whether the Fed is going to have to cut and cut aggressively. And we're not seeing that. You know, the bond market is still thinking that, you know, this doesn't really change the picture for the US economy right now. It doesn't change the outlook for Fed cuts, and that's ultimately what's really driving them. So we did see kind of, you know, a little bit of a shift in yields yesterday, about kind of 7 basis points lower for the 10-year. But we really haven't seen much of a reaction elsewhere. You know, gold, relatively flat. The yen, while stronger on the week, really doesn't seem to be moving kind of in response to any of these issues. And I've been kind of looking at some of the volatility metrics as well. Well, we did see the VIX pop, as you would expect, you know, to reflect that greater volatility in the S&P. We really haven't seen kind of an equivalent move in indexes of volatility for currencies or for rates.
OK, so we're back to working out where the volatility is and isn't in these markets. Let me ask you more about the yen. You mentioned the yen, and yes, it's up on the week. It was interesting to me. I was reading a lot yesterday morning, a lot of people, things dropping into my inbox, all about the yen and nervousness about when we get that next hike. But also, we're looking ahead to US data, and we have recent lived experience of US data causing us to rethink yield differential expectations and a big move in the yen, and we know what happened there. How nervous are you about yen moves?
Yeah, it's definitely something we're watching pretty closely. I think yesterday's move, we saw a 1% strengthening in the yen, and that was really off the back of some of the comments out of Japan from Ueda, the BOJ governor, around their commitment to continuing to hike. We're still about 30% chance of a hike priced for December, so it's not exactly nailed on as yet, but the BOJ themselves have been pretty clear about that. And I think there is that kind of sense of unease, just because this has sort of echoes of that late July, early August period. We've got a tech sell-off, we've got non-farm payrolls coming. You know, people are kind of thinking about whether there could be sort of spillover from that tech sell-off into a broader market sentiment issue. I think a lot is going to hang on that jobs report. You know, do we kind of see sort of signs that the job market is crumbling so fast that the Fed is really going to have to act very aggressively? The bond market's already pricing that, so it's going to take them a lot to go over and price more. But I think for stocks and for that wider sentiment picture, that's where that's going to be really, really key.
All right, I'm putting you on the spot here, Rachel. Brent crude is dropping pretty substantially as well. Some of us saying that is risk sentiment. Does the rest of the market have some catching up to do?
I think there's going to be a little bit of a recalibration around kind of oil, and we saw that feeding into the move in treasuries yesterday. But I'd watch out for it in commodity currencies. They're going to be a really interesting space to watch that play out.
Spoken like a true managing editor for FX and Rates. Rachel Evans, we thank you so much. You can get more up-to-date analysis and insight from our Markets Live team. Just type in MLIV GO on your Bloomberg terminals. Go from the macro to the micro. Lizzie Burden has our stocks to watch. Lizzie.
Well, Kriti, I would say mind the energy stocks, but I also want to focus on the European chip makers because, of course, we're looking for a read across from Nvidia, the biggest wipeout in history, these renewed concerns about the AI frenzy. And you've already seen the hit to the Asian chip stocks. You're looking at that risk-off mood in the US futures. We're looking, therefore, for a read across into the likes of ASML, Infineon and ST Micro when it comes to Europe. But let's flip the board over to Commerzbank because we also got some news from them after the market closed yesterday. In fact, the German government potentially looking to cut its stake. So currently it's about 16.5%. And we don't know how much they'll cut it to. We don't know when this will happen. But really the point is Commerzbank has been riding high on the European Central Bank's rate hikes. And you've seen the shares up about 20% this year. They hit their highest in more than a decade in May. And, of course, now the ECB's pivoted to cuts, the German government is thinking it wants to reap those gains because, of course, that tailwind is now limited with the cuts coming now. Finally, let's flip the board over to our final stock to watch this morning. We've got Barratt developments because we've had various earnings trickling out today, the insurer Direct Line, the meat supplier Hilton Foods and Barratt as well. They're in the process of acquiring Redrow to become the UK's largest home builder, and really they want to capitalise on the new Labour government here in the UK and its plans to overhaul the planning system. But in their results today they said that home completions in the past year were at the upper end of expectations, but that's still nearly a fifth lower than they were last year. So when you look across their metrics from profit to margins, actually you've seen sharp falls, and the guidance is that the completions over the current year are going to fall slightly too. Shares down 7.5% year to date. We look for the market reaction at the open.
Lizzie, thank you very much. Lizzie Burden with the latest on some of the stocks that could be in focus. We need to talk about a number of things. I'm drawn to a bit of a rush in European share sales this morning. We'll pick up on that as we go through the programme. Galderma, Deliveroo, Moonpig. You know, it's the start of September, that back-to-school feel, maybe people sort of reassessing capital requirements as we go into this sort of serious month after the summer that was. But broadly, we're all about that tech sell-off in the States, aren't we? Or the wider volatility we saw.
I think it's the volatility
equities.
that's interesting.
Yeah.
So the V2X yesterday was up 12%. You've seen that in the States as well. You've already had one warning at the beginning of August. That's going to make kind of risk managers nervous already and is going to have a lasting effect. You've now got another effect of that coming through, so that's going to make them doubly concerned about what is happening. You've seen a big drawdown in Asia overnight. The Topix was down really hard, so you've got that kind of warning again from Japan. It's going to be really interesting to see how this changes people's perception of risk. Do you keep going? Do you buy the dip? Do you do what you did at the beginning of August? You've been paid for that. Or
Are you waiting for payrolls data?
Or do you kind of, given the proximity to payroll data, are you going to be much more cautious?
Well, I think it's interesting. We're talking so much about the tech space as well, and that today's a little bit of a double whammy in that when tech outperforms in recent sessions, we've seen oil underperform, and then vice versa. And there seems to be that rotation, at least tug of war, that we've seen in the most of August, and I'd argue most of the summer as well. Today, it's both. And I'm curious to see what takes the bigger hit, the tech read-through from Nvidia, from what you see in Asia, or the oil read-through from what you're seeing coming out of the Middle East, out of Libya, out of Nigeria, and simply the fact that you have now seen Brent crude erase all of its gains for the year.
Yeah, I mean, we did move on that yesterday to some degree, didn't we? Here in Europe, we had that, some of that opportunity to price that in. And so energy stocks, some of them were down by more than 5% in yesterday's session, not the big ones, admittedly. But the whole sector was down by 2.8%. Basic resources were down by 3.3%. So the notion of weakness in China, weak Chinese growth, is not new for European stocks, but it's just, getting a handle on the scale.
It's just a scale issue. The scale issue is, Nvidia lost Chevron's value yesterday. That gives you the context of kind of what we're talking about here. When tech sells off in the States, the effect is so much more dramatic. Yeah, oil prices can go up, they can go down, ripples through into some of the European stocks. Yes, there's an effect there. But the scale of the move is just so different. And the impact on people's portfolios is so much more magnified when it's a tech sell.
The concentration is incredible, isn't it? I was reading some stats around Nvidia and its role. Microsoft and Meta spend more than 40% of their hardware budgets with Nvidia. Just the amount of focus on one business. No surprise regulators are looking at them.
Absolutely. And to your point, actually, you're talking about it from a business point of view. Let's talk about from the kind of rebalancing point of view. On Friday, I was reading a really fascinating story. This Friday, there is a rebalancing in the S&P 500 that potentially could knock Nvidia out of the biggest heavyweight of the S&P 500, not because of its sell-off, but because of Warren Buffett's kind of change in the way he sold his position in Apple.
Yeah.
So I thought that was interesting. On the other one, we're talking about the sell-off and how September is seasonally weak on both sides of the Atlantic. Just putting some numbers around that, 5% is the average drop in about a 5-year return for the S&P 500. It's about 2% for the stock 600, and that comes off a positive month that we saw in August.
Yeah, September is often a volatile place to be, and we find ourselves there now. European futures then a point lower for the start of trade. We'll be back with that European market open. This is Bloomberg.
Wednesday, the 4th of September, a couple of minutes to go before the get-go of trade here in Europe this morning, and there's lots to think about. Let's talk about the session yesterday and how the US evolved it as the day went on. This is the European session in white, couple of legs lower. The big one coming in the afternoon as the US out of the gates pretty much started selling. Back from the holiday, we saw the selling pretty much straight away, and it continued. So Europe went out about here. The selling continued in the States, as a result of which we've still got something to price in this morning here in Europe, Kriti.
We absolutely do. The sell-off already seems to continue. Risk sentiment is certainly down, and you can see that with an almost, I'm going to round up here. No, you're not supposed to do that. I'm going to round up. Almost a 2% drop, Anna, in those Eurostoxx 50 futures. We're now down, accelerating those losses. Remember, the FTSE 100 was only down 0.8% about an hour ago. It's now down 1%. Even over in the States, it looks like day 2 of a sell-off is what we've got on the agenda.
Yeah, absolutely. So we do see weakness in those US futures, and as you say, European futures looking to play catch-up to what we saw in the States, having factored in just some of it yesterday. In terms of individual stocks, European chip makers, well, that's a sector, but we'll certainly keep an eye on that one after we saw Nvidia in session lose $279 billion in market value. Then it was hit by some other news flow after market. We're also focused on Commerzbank. We're seeing the government there deciding to reduce its stake. They plan to cut their stake as it seizes on the recent share rally to initiate an exit from the lender it rescued over a decade ago. Doesn't mean it's going to make money on the overall trade over that more than a decade period. We're also focused on the house builders, as Lizzie was talking about. The message is to look forward. So even if they're seeing output slumping in the rearview mirror, they are confident in their ability to build more homes alongside Redrow as planning rules change, Guy.
Absolutely. OK, here we go. The Wednesday opening trade is upon us. Let's take a look at how those futures are going to translate into cash. This is what we are seeing already on the screen. Red as anticipated. Losses coming through. The FTSE 100, I suspect, will accelerate to the downside. Maybe it will see fewer losses, though, than maybe some of the other European markets. There's a little tech here, but there is some oil. So remember how that's going to be priced in as well. The 600's out of the gate. It is down by 0.6%. We'll see how that develops. Waiting for the CAC, DAX, SMI and IBEX all still to open. The IBEX is down by 1.2%. I'm rounding up as Kriti's already done. Let's see whether that continues to the downside. The CAC is down by 1.1% this morning. So we're starting to see a little bit more on the downside for the stock 600 right now. The FTSE's down by 0.9%. Still waiting for the DAX, still waiting for the SMI to open. But the expectation is we're going to see weakness in a number of sectors today. It is not just related to the chip story, but that is really where I suspect the epicenter of the action is going to be, Kriti.
I think you're absolutely right on that. It's a pretty broad sell-off you're already seeing from out of the stock 600, out of the FTSE 100 as well. And it's a lot of it is concentrated in some of the heavyweights. And I thought this was interesting. There it is, red on the screen across the board. Even if you do have some outperformers, Anna, some green on the screen in the likes of Sanofi, Reckitt, for example. There are a couple that are standing out. But net, it's Novo Nordisk, it's LVMH, it's ASML, it's even Shell. So again, sector by sector, your biggest heavyweights dragging this market down.
That looks like a lot of red, doesn't it? We don't have any sectors in positive territory. The best performing sector is still negative, and that's personal consumer goods, the likes of Reckitt, Benckiser, Carrefour going a little bit higher. Unilever holding its head above water, but elsewhere we are weaker. Financial services seems to be where we're selling here in Europe, and that's obviously a sector that Europe has some heft and some weight in. But UBS is down by 3.9%, EQT down by 2.4%. So a host of financial services names seem to be coming under the spotlight today.
BE Semi's down. You've got, it's an interesting mix, actually. So BE Semi's down. Aegon's down. Some of the insurers are seeing some losses here as well. UBS is under pressure, as you say. Really interesting mix in terms of the stocks that are seeing weakness this morning. Yeah. Richemont is down. We've talked about kind of what's happening in the luxury space, but Richemont is definitely off the pace this morning. Where are you seeing safety? There are a few thin pockets of it, but Reckitt Benckiser is a stock that stands out. Danone is a stock that stands out. Yeah. So people are definitely seeking safety in this market this morning. Yogurt is the place to go.
Consumer goods, apparently. Yogurt. I want to bring it right back to UBS because you mentioned that financial kind of concentration in terms of the sell-off here. After market yesterday, the Swiss regulator, FINMA, actually talked about reining in some of the things or some of the models that Swiss banks are doing. Well, I should say there's really just one now, UBS, in terms of their growth campaign. So I wonder how much of that is a little bit of a read-through into the UBS.
Let's talk about where we are on the broader risk sentiment right now. Yesterday, the team in the US, while markets were busy selling off, stocks were under pressure. The S&P down by more than 2% by the close. They caught up with Morgan Stanley's Jim Caron to get his assessment of how much bearishness there should be in these markets right now.
I think that the equity markets today are asymmetrically skewed to the downside, at least over the near term at these current price levels. So I think the market is going to really focus on the bad news right now. So bad news is really bad news. And that is probably what creates the correction that I think is going to occur in September.
Morgan Stanley Investment Management's Jim Caron there speaking to the team stateside as markets were selling off. Let's continue this conversation. I'm pleased to say we're joined by JJ Kinahan, CEO of the online trading provider IG North America. Very nice to see you, JJ. Really good day for you to be visiting us here in London. We're very grateful. We're very grateful for your presence. Thank you very much. So we just heard the Morgan Stanley view there, talking about a correction looking likely in September. September is vulnerable to that kind of thing. What are your expectations?
Well, again, it's the first trading day, just like the first really trading day of August. I think that August came back with quite a surprise. So to see us sort of visit halfway down to the levels we saw there isn't maybe a big surprise. How quickly we got there might be for sure. I think one of the bigger differences, the only reason I believe this can continue over a few trading days is if you look at the VIX, which measures volatility on the S&P 500, if you think about what it did in August, it was a one-day, really fast up, started to come off really fast. If you think about yesterday, it was a pretty orderly sell-off. There was no real panic. And so when you don't have a panic, that's the time it can continue for a few days. You guys talked about Nvidia a few moments ago. I think Nvidia is certainly, has become sort of the leader, if you will, in terms of how people view the stock market. The thing to keep about Nvidia is the last 3 years, it's been down on average 13%. And so, we see it, of course, down yesterday. Looks like it's going to be down this morning with some of the news after the close yesterday. So with that, I think that's the type of thing that hurts sentiment and puts people on the defensive looking to sell assets.
And when things sell off in August, it's easy to say, well, people are on the beach and it's overdone. Let's wait until people come back to their desk. But September has a different feel to it, doesn't it? Does that add another dimension?
I think it does because it's the time of year, to your point, when people are back from the beach, kids back to school, so you're looking at everything every day, and people are cleaning up maybe their portfolios, et cetera, what happened in the summer. So obviously a big cleaning yesterday, if you will, and so we'll see what happens over the next week. Again, I'm not real panicked about it right now, to be honest with you. I think what it does do, though, is as we head into Friday with the employment numbers, that becomes much more interesting, as does the Fed meeting here in a couple of weeks.
What's the trade? If you see a beat on employment, does that throw out all the rate pricing?
No, I don't think it does at all. I think, if you look at the probabilities of a rate hike, it just seems almost inevitable that we're going to have one now. I think the real question comes at the next meeting and how many we get before the end of the year. In terms of what's the trade, I look at what our clients have done the last few weeks. The stocks they've been buying, of course, been Nvidia because it is a leader of retail stocks. But we have also seen Visa, and Chipotle with the new CEO has gotten a lot of support. And on the sell side, it's been really interesting. You guys were just talking about buying food, buying yogurt, where we've seen, our Tasty at IG and our Tasty Trade clients selling has been McDonald's, Starbucks, and Disney. So
is that a China trade, though, on McDonald's and on Starbucks?
I think it's an inflation trade.
Okay.
More than anything else, to be honest with you, because people, again, as they start to feel higher prices, are they willing to pay up to, £4 or £5 for a cup of coffee? And I think on the other side, it's really interesting to me that Visa has done well, or people like Visa. And the reason I think that's happened is because the stores like Dollar General, et cetera, have done so well. So people have maybe moved down the scale a little bit. What concerns me there is what will be, we're already at such high debt levels in terms of credit cards. Will that continue?
Oh, man, I could talk about these stocks forever. Let's talk about the chip sector, though, because this is a one that's certainly bleeding into the European session. And I think so much of it gets roped into the Nvidia trade, the AI trade, et cetera. There's also an argument here that there is a Biden-Trump kind of trade mixed into it as well, given so much of the chip sector has benefited from the CHIPS Act and the IRA story, that it is ultimately a fiscal spend, one that's now dropping mostly because of options trade. How do you view the chip sector? What is going on there? What's it responding to?
Well, I don't know that I would say it's dropping because of the options trade necessarily, but we have seen a lot of puts be purchased over the last few weeks. There's no question about that. But the chip sector in general, I agree. I think there's something else that's going on there that you saw not in Nvidia's earnings, but in earnings from Amazon, Microsoft, et cetera, from the analyst questions afterwards. So much money's been spent on AI over the last couple of years, particularly in the last 6 months. How are these companies going to monetize it? And I think that's what's really happening is they've spent so much up front. Nobody's really answered the question of how are you going to monetize the hundreds of millions of dollars you spent up front, and where is that coming from? And I think until somebody shows some real payoff for the money spent up front, that's going to be the primary question. And that's the thing, to me, that's the biggest concern for Nvidia.
Am I going to get paid for buying the dip this morning? Is that the right trade?
Here's what I would say. One of the reasons that we started Tasty at IG here is so that people can trade options and futures back to the U.S. For those who understand options, to me, this is a time, rather than just buying stock, maybe you think about selling out of the money puts if you do want to buy a stock. Yep. But the other thing to consider is this for retail traders. Too often, they're all or none. if you're buying the dip, what I would say is if you have 200,
Average.
300,
Yeah.
oh, absolutely average, 100%. This is the time to do it. And if you say you had 300 shares to buy, you only got 100, we bounce back. Boo-hoo, you were right and made money.
In terms of the slightly longer term picture, though, in terms of sort of buying the dip, do you get a sense that the highs are in for the year? Do you get a sense that the more longer term picture is one that stocks are going to struggle in?
I don't know that the highs are in, but here's what I will say. I think the volatility level will absolutely continue for the rest of the year to be elevated.
So
well, actually, to be closer to historical, to be
Okay.
honest with you, because that's where we're really at. We were just at such a lower volatility, of such a low VIX level for so long.
But that has an impact on risk. If I'm a risk officer, I'm looking at that VIX, I'm going,
Absolutely.
you know what, you can't take, your manager, you can't take the risk that you were taking before, and that takes money out of the market.
It adds a problem of liquidity at times. That I agree with 100%. In the biggest stocks, that may not, the Apples, the Nvidias of the world, that may not happen. Now, on the margins, it may, because people aren't going to be able to sell way out of the money puts, buy, or sell way out of the money calls. But for the stocks that trade a lot, I think they'll continue to trade a lot. Some of the other trades, or some of the stocks that aren't in that top 20 to 50, that's where you may see some of the liquidity drain. Markets widen out a little bit. That's where you have to be a little more careful. Always be the smallest fish in the biggest pond.
A topic that we talk about a lot, I'm bringing it back to the chip sector, is every time we have an Nvidia earnings report or a big tech earnings report, it doesn't seem to be hedged to the downside. I think Apple was the exception to that. Nvidia, for sure, the hedging to the downside was very, very cheap, and no one was buying into it until now. And I think this is really interesting. Walk us through, one, why that was happening, and two, whether that's going to change given the last time we've heard from them.
Well, I think memories tend to be short. I'll say that. So for the next 2 quarters, I would expect that you would for sure see it. But again, you know, their earnings weren't bad, though. Let's say this. Their earnings were pretty good earnings.
Yeah.
I just don't know that there was a number that they could have come out with that the street would have been satisfied with. So I think that's what they faced, is it's done, the stock's done so well. What were you going to say? Yeah, we beat on every metric. We didn't beat by, you know, $10 per share. So, again, I think that was a little bit of the issue. But as I said, I think they did so well that they're almost a little bit of a victim of their own success. I do find it interesting, Kriti, to your point, that maybe you didn't see as much hedging to the downside. But, again, this is a stock that you didn't get paid to hedge to the downside for the last couple of years. Every time you did, you lost money. So I think people are like, well, you know, until they're shown that it pays off to do, they won't. And now, to your point, I think what will be interesting is to watch the out-of-the-money puts over the next couple of earnings cycles. I would expect those prices to be a little bit jacked up.
Nearer term, we're looking ahead to a jobs report on Friday. With this volatility on just day one of September in US equity markets, how are you thinking about Friday and how that report might go down with markets?
Well, I think that, you know, as many have been saying, bad news is now bad news, which is a little bit of a change in the market. So I think a miss on jobs will hurt significantly, and a beat will probably be looked more favorably. What I like to look at is where are the jobs created, and what I mean by that is many of us have started out in our careers working in restaurants or bars or whatever, or the hospitality industry, and that's fantastic. But you want to see careers being created. What's going on with manufacturing? What's going on with transportation jobs? Those are the types of jobs that I would look for. You will probably start to see, you'll see, I would think, more government jobs because cyclically, as we talked about earlier, Anna, kids are back to school in the U.S., so the teachers being hired, et cetera. So I would expect the government jobs to be a bit higher. But I think you have to read through as to where jobs are being created, and that's the most important part of the report.
JJ, thank you so much
for
passing through our studio as you're in London. JJ Kinahan, CEO of IG North America. Guy, it seems that stocks off their lows but still down in Europe, and the tech sector really being hurt today.
There's also downgrades in the markets. ASML is under pressure as well as a result of a UBS downgrade that is impacting that stock. Volatility is the story, really, that we're watching very, very carefully, and it's the VV, it's the volatility that I think is really worth paying attention to at the moment. In terms of what we're watching, in terms of the core six, look, there's some significant losses there. Look at where the market is hiding out. Nestle, just want to double-check that one and see what's going on there. But it does seem as if yogurts and food and things like that appears to be a safe haven this morning, as is Ferrari.
Are you hungry? It must be.
At this time
it's the
of the morning.
treat economy, isn't it? Isn't that what they call it? The, chocolate.
I'll just call it the breakfast economy. That'll do. Ferrari down a little bit. Luxury kind of is a little all over the place, but the action's certainly centred in the chip sector this morning. Look, we were talking to Schneider a little bit earlier on. It seems to be actually doing fairly well this morning, but ASML on that downgrade is getting hurt.
Guy, let us check in on some of the other movers in this morning's session. Lizzie Burden has a rundown.
Well, Anna, I want to pick up on that theme because we'll start with the European chip sector, and you can also see the hit to the likes of Nvidia and ST Micro this morning off the back of the Nvidia sell-off yesterday. But if we flip the board to some of the other movers this morning, Deliveroo, Kriti, I know you were expecting a move. This is after Bridgepoint sold its remaining stake, and indeed the shares down nearly 3.5% this morning. Flipping over again, one of the other potential movers we were looking for was Telia, down 2.2%. Not as big a move as perhaps expected, but the news is that they're aiming to cut headcount by 3,000 jobs this year across all the units, but perhaps not as big a move as expected because this headcount has been happening on a year-on-year basis, these cuts to headcount, for the past 11 quarters. So down 2.4%. Flipping over to the next mover of the morning, we have Barratt Developments. I told you we had the earnings earlier, and the bigger picture is, of course, that they're looking to capitalise on this new Labour government's planning overhaul. They've got their tie-up with Redrow. They're acquiring it to become the UK's largest home building operation. But the reason that they're in the red this morning is because if you dig into their results, actually they have said that, yes, home completions in the past year were at the upper end of expectations, but that's still nearly a fifth lower than this time last year, and sharp falls across most of their metrics from profits to margins. So Barratt in the red. And just finally, flipping over to Commerzbank, we were talking about it earlier. You're seeing the German government looking to reduce its stake from 16.5% because Commerzbank had been riding on the ECB's rate hikes. Now it's cutting rates, and so traders looking to follow the German government's lead. There are movers this morning.
All right, Lizzie Burden, we thank you so much for walking us through some of those early movers. We're going to have more on that Commerzbank story. As, of course, Lizzie mentioned, Germany planning to cut its stake in the lender. We're going to dive into the details of what's behind the move, what we're seeing, and why. Stick with us. This is Bloomberg. Welcome back to the opening trade. We're about 20 minutes and change into today's session. You are seeing red across the screen, although bouncing back from some of the lows we saw at least 10 minutes ago. So you are seeing a little bit of a revamp. We'll see if that leads to some sort of positivity later in the session. But right now, tech very much dragging on the index, as are financials in this part of the world. Right now, you are seeing the Euro Stoxx, or actually the Stoxx 600, down about, we'll call it 1% if we can. There's another major story that we're keeping our eye on outside of the stock market, and that's what's coming up later today at about 3 p.m. UK time. We are going to get a closed-door report from Mario Draghi. It looks like he's going to be speaking to senior parliamentarians over at the EU. Guys, I think this is really interesting as well because we've had a leak from it already. He's talking about competitiveness getting in the way of a defense ramp-up. This is a widely expected report. We may get some more leaks out of it.
I think we probably will.
Yeah.
I think the expert. Talk to parliamentarians. I think you're going to get some leaks.
I'm willing to go out and say that. But I'm curious what else he says, especially given he's a very well-respected person.
Yeah, absolutely. When somebody like Mario Draghi lends the benefit of his expertise to assessing the competitiveness gap between Europe and the United States, you want to pay attention. But will he have any more answers than the other reports? I think it was 2010 we got another report on European competitiveness, and it's a perennial problem, isn't it? And he's already told us there's a lot of money we need to find for green and digital technology.
European Commission should be paying attention. This is going to be effectively what it needs to deliver over the next Parliament. And you do also wonder with the gaps at the top of the German government and the French government, are we actually going to see any of this enacted? Talking of Germany, let's talk about what is happening with Commerzbank this morning. The German government is going to be selling down partially its existing current stake in that bank, which it took on, remember, 07-08 as a result of the financial crisis. I think it needs to get out, Steve Aarons was telling me, at 26 to break even. it's not going to do that. The stock is currently trading at 12. Steve, why is this the right time to be getting out for the German government?
Hey, so, I mean, yes, the government would have to achieve a much higher price for it to break even. But, you know, it's water under the bridge, essentially. What they're looking at is the share price rally that's been happening at Commerzbank for the past 4 years, really, thanks to interest rates hiked by the ECB. And that share price, you know, is just much higher than it used to be. And they're seeing an opportunity to take advantage of it and, you know, make some money, I suppose.
OK, so it's opportunistic, perhaps, given the recent history of Commerzbank's share price, even if over the longer term they don't make money here. What does it mean then, Stephen, for Commerzbank itself? You know, when we speak to them about this, and Kriti was reminding us, we talked to the CFO about this very subject recently, they usually say, well, that's something you've got to talk to the government about, obviously. And what does this mean for the bank?
Well, I think if a big investor decides sort of to sell down a stake in a company such as Commerzbank, it sends a signal, you know, we don't expect the share price to go up much higher and for longer. And so other investors will probably think about, what does it mean for us? We have reported previously that Commerzbank is looking for fresh investors. And now that the biggest one is reducing its stake, I think that task is becoming even more urgent for them. And those will be the challenges facing Commerzbank CEO Knof and CFO Orlob for the next months and even years.
Stephen, thanks very much. We're both Steve Aarons with the latest on Commerzbank and the decision by the German government to sell down its stake there. Let's talk, well, we'll go from the business of banking, retail banking and other banking in Germany to the wider monetary policy backdrop in Europe. And Kriti, this is something that you put on our radar. This is reports in the Spanish press that we're finally going to hear today, or there is an expectation we finally hear today, who is the central bank governor over in Spain, because they've been without one for 3 months.
Yeah, they have, and have therefore forfeited their vote when it comes to monetary policy as well. I think what's interesting is that this is an announcement that's due to come, I believe, 3 p.m. Madrid time, 2 p.m. UK time as well. And I think that the candidate here is really interesting. This is someone who's currently the Minister of Digital Affairs right currently. He's had a history at or a resume that boasts the Bank of International Settlements, the BIS, BBVA, which is one of the top banks in Spain and arguably around the world as well. How does he really take on the monetary stance of Spain right now, which is an economy that is outperforming, by the way? This
is really interesting because normally this is an apolitical decision. So this is somebody that everybody within the political classes are happy with. You make that decision and you put that person forward. As you say, this is not that this time. Not everybody's on board. Not everybody in Spain within the opposition thinks that this is the right guy to put forward. And I think that's really interesting that tells us something about where we are in Spain and the kind of the potential instability that could work around this as well. And kind of if the government changes, how does that change in terms of the central bank position?
Yeah, and we're just showing pictures of José Luis Escrivá. We should reiterate there's no decision made yet. So this is just the expectation. This is the name doing the rounds in Spanish newspapers, isn't it, essentially, Kriti? An expectation that... but to your point, the politics gets in the way here, in particular for somebody who's actually worked for the Spanish government. So this is a person with a whole lot of experience in lots of different aspects of banking. He's been at BBVA, he's been in government, he also worked at the BIS, and he worked previously at the ECB. So he brings a lot of experience if he gets that job.
He does, and I think this is something that you often ask in terms of the wider European context, but this is someone who is kind of facing the issue of a technocrat and whether a technocrat should actually be in that position, simply because that was the pushback against his predecessor, Hernandez de Cos, and that's actually ultimately one of the factors that led to his removal as well.
But you think about it, central banks are becoming more politicised.
Right.
I think is a question.
And vice versa.
Maybe, yes. But you think about kind of what Donald Trump's saying about the central bank in America and about independence, about how critical that is or not critical from his point of view. Politics beginning to, boundary beginning to blur a lot more at the moment.
We have a rate decision in Poland later this morning, and there's no expectation that rates change, but that in itself is attracting political attention because the central bank governor came back from Jackson Hole where the US are talking about cutting interest rates, and now politicians in Poland are asking that question of their central bank governors and saying, when are you going to cut interest rates? So, the politics is there in the background.
And if I remember you correctly saying, this is the first time they have a rate decision. They haven't changed their rate in about 11 months or so.
They definitely haven't changed for a while.
For a very, very long time. All right, we're going to go from Poland to a different part of the world coming up in the program. We're going to dive into Israeli Prime Minister Benjamin Netanyahu holding his hard line on Hamas. That convo next. This is Bloomberg. This is the opening trade. About 30 minutes into today's session, we're getting breaking news crossing the Bloomberg terminal coming out of Germany, set to target a sale of about 3 to 5% of a stake in Commerzbank. Look, they're still going to be holding on to it. Guy made the point earlier that for them to actually make money on this investment, the stock actually has to double. Whether or not we get there is a very, very different story.
Got to get to 26. That's just a break-even rate. So to make money, you've got to go even higher. And you sell some of it now, that makes that number even change quite significantly. Why don't they? Why are these banks? Why are these governments still holding these stakes? Same with the UK government. Why are we still in a position where 10 years on from the financial crisis, we're still in a position where a lot of these governments in Europe still hold bank stakes?
Well, we have seen the UK government getting out, the previous one, getting out of NatWest gradually, and they had a plan to put that to a retail audience and try and sell it that way. In Germany, I don't know the answer to your question, but I wonder, is there anything to do with M&A that's in the minds of people in Berlin here? You know, we talk about cross-border M&A. Will that ever be a realistic opportunity in the Eurozone? We also talk about within-country M&A. Now, depending on what flavour of M&A were to present itself at the doors of Commerzbank in some future made-up universe, you know, would a German government want to have a seat at that table? I'm just asking the question. I don't know the answer.
I don't know the answer either, and it's more than 10 years ago. It's going to be more than 10 years ago.
Oh, memories are too short.
Feels like it was just yesterday. But I'm curious, and given the budgetary constraints as well. Take the money.
We're going to have to see how this all plays out. It is a fascinating one, though. I got to say, it was one of the major culture shocks here that so many of these European governments do have stakes in a lot of these companies, not just the banks as well, but the likes of infrastructure places, Telefonica, Telecom Italia. There's plenty in the periphery as well. So, of course, we'll be monitoring that story. Those shares down just shy of about 3% right now in today's trade. I want to make a little bit of a pivot here and talk about another story that we are keeping an eye on. The U.S. Justice Department has announced criminal charges against 6 senior Hamas leaders on counts of terrorism and conspiracy to kill Americans, including some linked to Hamas's October 7th assault on Israel. It comes as President Joe Biden expressed frustration with Benjamin Netanyahu's efforts to secure the release of hostages held in Gaza. Michael Froman, president of the Council on Foreign Relations, spoke to Bloomberg about how President Kamala Harris, if indeed she does win the Oval Office, might go further than Biden in terms of ratcheting up pressure on Netanyahu. Take a listen.
I think the matter of emphasis is that there are some small indications that she has been more willing to say out loud what we know the Biden administration has said privately to the Israelis, which is that they've got to do more and better to avoid civilian casualties in Gaza.
The Council of Foreign Relations President Michael Froman there speaking on Bloomberg's Voternomics podcast. Let's get a little bit more insight here and bring in Dalian Scheinlin, political analyst and author of new book, The Crooked Timber of Democracy in Israel. Dalia, a pleasure to have you on the program. I think one of the big questions the international community is asking is this time different? The pressure that we're seeing build up domestically on Benjamin Netanyahu will actually change anything in terms of his approach. Your thoughts?
It's impossible to say 100%, but I have to say that many Israelis feel like the country has been through various rounds that look a lot like what we're seeing now. There have been people on the street for months. Every single week there are major protests. The difference is that, A, the protests became much bigger, possibly up to 300,000 people were on the street on Sunday night, and then continuing every night this week. And, of course, that there has been a strike called by the major labor union, Labor Federation, Histadrut. And so there is some more kind of pressure that's not just about people demonstrating their anguish, but also about actions that can sort of constrain the country. However, Netanyahu has reacted so far with his typical reaction, which is to dig into his position and try to argue to the Israeli public why there cannot be the kind of compromise, particularly over the Philadelphia route that separates Gaza from Egypt, that he has most recently decided is the actual deal breaker with relation to reaching that ceasefire hostage deal with Hamas. And so he is certainly giving off signs that he does not plan on changing policy right now. And we have reason to think, based on all the rounds prior to this point, that he still does not intend to get to that kind of a deal.
You make a crucial point on that Philadelphia corridor, which, if I'm correct me if I'm wrong, Egypt is saying is a non-starter when it comes to that border or their northern border there. Dalia, talk to us a little bit about where his support is actually coming from. If you, as you outline, see pushback from the trade union, from the top courts, from his war cabinet, not to mention the opposition, what support is he actually able to tap into?
Well, first of all, he doesn't only have the support, he has the ironclad loyalty of the two coalition parties who are essentially holding an ultimatum over both him and the Israeli public. Not that I want to suggest that Netanyahu is backed by them. I think they are essentially aligned on this. But his two coalition partners, who represent two very extremist, ultra-nationalist, frankly, fanatic parties in government, are saying and have been saying since the very beginning that if there will be a hostage release ceasefire deal, they will leave the government, they will take the government down. That would throw Israel eventually into elections, even though there is sufficient support from other parties for Netanyahu to pass the kind of hostage release ceasefire deal that's being discussed. He could definitely get that done, but he is concerned about losing power. So first of all, he's got the political support and alliance of those parties. Now, I should say that although surveys regularly show that a majority or a plurality of Israelis support hostage release deal at the cost of Palestinian prisoner release and a ceasefire, there is a not insignificant minority of Israelis who are opposed to that deal, even though everybody will talk about and certainly probably feels, well, I say certainly and probably, people all feel the compassion and empathy and anguish for the hostages and the families themselves. But there is about, I would say 35 to 40% who think that to make this kind of a deal, even in order to get the hostages back, is wrong, is a security threat, and would mean that Israel is capitulated to Hamas and possibly given incentives for future hostage taking. And so that is an argument that Netanyahu is able to leverage and exploit, and it's not an insignificant argument. But there is a very widespread feeling in Israel that those aren't the real arguments. The heads of all the security establishment have been saying over and over again that Philadelphia corridor should not be the deal breaker. The Israeli security establishment can cope with the challenges of the Philadelphia corridor through various mechanisms that have been proposed over time. And that, people who've worked most closely with Netanyahu, including his former war cabinet partners, who've come out and said that is not the problem. Netanyahu is stymieing this deal for his own purposes. And he does not need to take, the security considerations are real, but they are surmountable. And that he is doing this primarily in order to stay in power. So whether or not we can look inside Netanyahu's head, that is a very, very widespread perception among the public and among the people who've worked most closely with him.
Dalia, I wanted to pick up on that point, and you've mentioned it a couple of times, but just to sort of get more of a sense for the international audience on this, to what extent is there this perception then in Israel that Benjamin Netanyahu is deciding is making decisions based on his own expectations about his political fate rather than necessarily what's going on in the country as a whole?
Well, surveys have shown us since the very beginning of the war, almost from the first couple of months, that those are the considerations in his mind, or at least part of the considerations. There are very few Israelis who believe that he is making the wartime decisions absent these personal political considerations. Again, Israeli society is deeply divided. But, as a broad rule, you can imagine that anybody who is currently saying that they would vote for parties of the opposition completely believe that he is making decisions for a political reason. And anybody who is currently stating that to survey researchers that they would vote for the current parties of the current coalition, it places somewhat more faith in Netanyahu. But he has lost the majority in all surveys since October 7th, and frankly, before that as well. And so what we see now is roughly 40 to 45% who would vote for parties of the current coalition, not a majority. And those people are more likely to think that he is making decisions for the right reasons, or even if he's making them for the wrong reasons, that they agree with his decisions. But very consistently, we have a majority of Israelis who want him to leave office and not run again for prime minister. And that runs as high as 65, 70% in most surveys. Similar numbers say they don't trust that his decision-making is fully for the good of the country and is untainted by political considerations. Most believe that he is taking his personal political need to stay in office into account in making these decisions at the expense of the lives of Israeli hostages.
Dalia, if the objective here is to bring Hamas to justice, how significant is it that the US Department of Justice has unsealed these terrorist charges against senior leaders of Hamas? How does that change the calculus when it comes to Israel's perception of what needs to happen next and the ultimate objective of achieving that justice for what happened?
I think that it would be a little bit misleading to put this in terms of Israel's aim to hold Hamas to justice. What Israel has named, certainly the prime minister has named the aims of the war many times, and that is to destroy Hamas's military and governing capacity, to make sure that Hamas can never threaten Israel from Gaza again, and to get the hostages back, which nobody really believes that's a high priority for him anymore, and to get people to be able to return back to the northern border. That's how Netanyahu has defined the aims of the war. Bringing Hamas to justice is not one of those aims. However, I do think it's very critical because, there is frankly, a little bit of an inexplicable perception that has been permeating Israeli conversations that somehow the U.S. is not sufficiently on Israel's side. And it's not a mystery. It's because the prime minister does a little dance on the one hand, conveying that he's a great friend of President Joe Biden and that Joe Biden has been very loyal to Israel. But on the other hand, every single thing the U.S. tries to do to use that credibility with Netanyahu and to use that very stalwart, practically overwhelming support of money and arms and political cover. Every time the U.S. tries to do that to push Israel even just a little bit towards accepting a ceasefire and a hostage release deal, which is for Israel's own benefit, Netanyahu, on the other hand, then portrays that the U.S. has overstepped and is possibly not loyal enough, and that a Trump administration would be better. These are the kind of implicit messages that are conveyed. We see it playing out in Israeli surveys. And so back to your original question, I think the announcement this morning from the Israeli public discourse perspective will essentially reverberate in ways that say, well, the U.S. is behaving in a balanced way. It is certainly targeting Hamas for its, for this kind of sanction, as opposed to just placing sanctions on Israeli settlers, which is interesting because that's how Israelis see it. They are prone to dismissing the overwhelming American support for Israel and focusing only on the fact that U.S. had placed sanctions on a few of the most violent settlers and settler organizations. So this will portray to Israelis that there is some sort of a balance in how the Americans approach it, which in itself is misleading because, of course, America has been so overwhelmingly supportive of Israel. But still, that is the reality of how Israel is seen.
Thank you very much for your time, Dalia Schindlin, political analyst and author of The Crooked Timber of Democracy in Israel. We appreciate your time and thank you for bringing us an update on politics in Israel. Let's pivot to another geography entirely, and Ukraine is bracing for IMF pressure to devalue its currency and to cut rates. Red headline across the Bloomberg terminal tells us that there is an expectation, and this is people familiar with the situation talking to our reporters. Ukrainian officials are expecting that the IMF will put this pressure on the country, and the result of this review could be that they're able to access more funds, $1.1 billion disbursement to Ukraine.
We've obviously seen the deal done on the debt recently.
Yeah.
I think the effect of all of it is basically just trying to stabilise the situation, as you say, to access more money further down the road, to make sure that actually the numbers stack up, that the currency is actually probably at an appropriate. There's all kinds of levers you need to pull here. I think the big one was the debt.
The big one was the debt. I think it was like a 20% review as well. The $1.1 billion disbursement is interesting as well because something that the Ukrainian government is considering in terms of a fundraising approach domestically is something like higher taxes. So a weaker currency hits that as well.
And our story points out that depreciation of the currency and higher taxes all would be quite politically damaging. The population obviously ravaged daily by war. And continue to watch that story. Let us pivot to what's coming up next on the programme. Coming up, oil extends losses after a drop of almost 5% yesterday. We take a look at what was behind that slide. Oil prices continue to slide today. 69.28 on WTI, 72.74 on Brent. We'll get an update on what's driving oil markets. This is Bloomberg.
The data disappointment was a PMI that was expected to be 49.5 and came out at 49.1. Does that justify the oil market being at a record short? Absolutely not. It's not a collapse that would justify the market being as short today as it was in the global financial crisis of 2008.
Of course, Jeff Curry, Chief Strategy Officer for Energy Pathways over at Carlyle. Now, talking about China and the impact that its data is having in terms of the oil price that we are seeing. Oil extending declines. We saw a big loss yesterday, 5% circa to the downside. the possibility of political unrest, easing in Libya, maybe shifting the focus back to what is happening with the production boost that we're expecting by OPEC+. There's a lot of kind of forces coming together here. Let's try and get some answers. Bloomberg's Anthony DePaola joins us to discuss what is happening here. Jeff Curry's not convinced this is all China. If it's not all China, what is it?
Yeah, Guy. Hi, good morning. You mentioned some of those different factors in there. The OPEC Plus boost that's coming in early next month, where they're going to bring back some of the oil that some of those members had taken off as part of those voluntary cuts. They're going to ease those back into the market, that is. And we've got Libya potentially coming to a solution to this political crisis that has caused oil production and exports to be cut off there in that country. That's about 500,000 barrels a day of oil that's been taken off the market in Libya. Libya normally produces and exports about 1 million barrels a day, so it's a big chunk of the oil market. But Libya is very unpredictable. We've seen them cycle up and down many times. Over the last 3 years, they'd reached a little bit of stability, but now we're seeing over this past weekend fields being shut down, opened up, coming back. We had seen vessels continuing to load and export over the weekend and through today. We still have some there, but crude in storage is limited there, so that has an impact. But this news that they may come back in the market, that they may reach that political solution, that was really the spark that kind of put things off yesterday and really led to this decline.
Well, Anthony, you point out the crucial news there, and I want to just dive in briefly to discuss the very political crisis that you have broken down for us. It's erupted over control of Libya's central bank and stalled oil production, as you mentioned. Stick with us here. Bloomberg spoke to the ousted central bank governor yesterday about the country's dependence on oil. Take a listen to what he had to say.
There is, liquidity crisis as well, and, the barrel rate started, skying up, which is very bad. We are fully dependent on the oil revenue.
Anthony, I want to bring you back into the conversation here. Walk us through, for an international audience, just how important those flows from Libya are in a global context.
Yeah, 500,000 barrels a day. That's out already. That's a big chunk of the oil. I mean, if we talk about Libya's total production, 1 million barrels, that's roughly kind of what we would see in terms of a demand increase. So over a year. So that's really a way that would shift the market, because as we look forward, we're looking at non-OPEC plus production coming online. It happened this year. It's set to happen next year. That pretty much takes up all that demand increase. So if we had Libya come out, that would kind of cancel out that supply from outside of the OPEC plus group. But listening to that central bank governor, it doesn't seem like we're going to get that. They are working towards a solution. There are international bodies and world powers also that are talking with the Libyans to try to find a solution there. And you'd think that the Libyans themselves would want to get that oil back into the market because they need that income. Even if prices are lower, they still need that income coming in. But we are really dealing with this kind of difficult market. And any kind of movement like that, production out, production in, has the capacity to move the market up or down.
Anthony, thanks very much. Thanks for explaining some of these dynamics in the oil markets. Bloomberg's Anthony DePaola with the latest there. And we do see oil prices continuing to be under pressure, losing another 1% today. Let's switch our attention to another story that is in a related field. Africa's biggest crude producers in focus there. Nigeria also in focus, which up to now has imported all of its refined oil products. This country is now saying that the new multi-billion-dollar Dangote refinery will start distributing gasoline by this weekend. So this country making the step into refining. Let's bring in our Nigeria Bureau Chief, Anthony Osei-Brown, who's in Lagos for us. Good to speak to you, Anthony. So how long until the refinery is running near capacity? Because, yes, there's a sort of this positive story about moving on to being able to refine their own products, where previously they had to import those. But they've still got a long way to go until they get to capacity.
Yeah, currently I think the estimate we have is that the refinery is running around 50% of its 650,000 barrels per day capacity. We're not certain what capacity they will be running at when they start producing PMS, which is expected to start rolling out over the weekend. They started filling tanks yesterday, and hopefully by the weekend, they will start distributing across the country. The downstream regulator, regulator in the Nigerian sector, said they are estimating that Dangote will be producing around 28 million barrels, 28 million liters of gasoline daily this month, and that will increase to about 30 million liters by next month. Nigeria consumes an estimated, that's very debatable, between 40 to 60 million liters daily. So we don't know when they will be able to meet that full capacity. But then when the Dangote refinery starts producing at full capacity, they're able to meet all of Nigeria's demand and have enough to export.
Anthony Osei-Brown reporting for us over in Lagos. We thank you so much for bringing us that crucial context. For more on the story and other key trends across the continent, do not miss Bloomberg's Africa Amplified, which airs this Friday. Of course, we're going to be diving into all of the political dynamics and the implications in the oil market as well. A lot to digest there, but of course, that on the radar for this week in terms of oil. Plenty of other things on our radar as well when it comes to the broader data that we're watching. Of course, we have plenty of Fed speak as well. Actually, sorry, central bank speak. Force to have it there. ECB Governing Council member Francois Villeroy de Gallo will be speaking alongside that plenty of that U.S. data. We're all kind of waiting for that payrolls number on Friday. But until then, trade balance, factory and durable goods orders, we'll see if that moves the market or if everyone just kind of waits on the sidelines, digest the sell-off that we're seeing in the stock market. But for me, it is all about two very key items happening today at about 2 p.m. and 3 p.m. UK time, respectively. Spain announcing their new central bank governor. What does that do to ECB policy as a voting member? And then, of course, what do we hear from Mario Draghi around that competitiveness report?
Yeah, absolutely. So what new will he add to the conversation around competitiveness? That gap in technology investment between Europe and the United States has been much talked about, and we deal with it daily, don't we, when we talk about the up to recently epic performance of US tech and how that translates imperfectly over the Atlantic into Europe, even though we do have big names such as ASML. So we'll focus on Draghi. What does he have to say about the green policies in Europe and how that plays in? Of course, we're dealing with a much changed landscape internationally since the last time Europe thought about this. If you think about China and its role in the global economy, the US Inflation Reduction Act, that caused a lot of panic in Europe. How is Europe going to remain competitive with that kind of incentive in the US?
And European tech stocks are under pressure from the United States in terms of their relationship with China. You've only got to look at what's happening with ASML and the impact that is happening there. Let's talk a bit about the market this morning. So we are seeing softness. Technology is down pretty hard, 2.5% this morning. ASML is one factor behind that, but the chip sector broadly is under pressure. ASML, there's UBS downgrading the market this morning, which is also adding to that. Luxury significantly is also selling off. Energy is down. That's certainly a drag on the London market this morning. So names like Shell are under pressure. We'll see what the JOLTS number delivers a little bit later on. Keep an eye on that. It's the labour market data over the next kind of 3 days that I think is really what the market is now focusing on. We see the sell-off. Now what happens in terms of that data, in terms of whether or not this is a buy the dip opportunity or whether this is something that continues. Do we get 50 from the Fed on the back of this data, or do we only get 25? So it's JOLTS today, claims tomorrow, payroll numbers on Friday. Got to throw ADP into the mix as well.
I'll throw one more in there. We got the beige book tonight. I didn't even mention it, but I think so many people are kind of looking past it because it kind of feels like Chair Powell has almost, in some ways, boxed himself into a corner, saying 25 is what the market is going to see in September when it comes to, or this month. I forget the word September.
Away from the data, just getting some lines from Deutsche Bank. We were talking about German banking a lot because Commerzbank in focus, the government selling down its stake there. The Deutsche Bank CEO is commenting at a Q&A event being asked about this and saying a Commerzbank deal is not a topic for us right now. I mean, how many times have we asked that question?
Volatility's up in Europe as well again today, so you've needed another big spike in volatility. So I just want to put that out there as well. Volatility is not coming down this morning.
OK, we'll watch volatility, of course. At 9:30 a.m. London time, The Pulse will be speaking exclusively to the founder of HomeServe, Richard Harpin. That conversation coming up in the next hour. This is Bloomberg.